Get your stimmy, buy a share or two of your favorite tech company, or better yet, buy a few 2x4s. In order to stimulate the economy, the government has sent out a massive flow of cash to a big group of people. For those who need it, it might be a lifesaver. For those who don't, this should make its way into the stock market. Like last time, many were pumping more into the markets, and so this is an indirect bailout of the biggest companies in the world. But hey, they care about you, don't they? You came here for the truth, so let me unveil that for you. That's how I wanted to start off this video. Set the tone. What we are looking at here is, as I said, an indirect bailout of the biggest companies in the world. We're going to talk about the stimulus. We're going to talk about the Federal Reserve. New FOMC meeting comes out, and guess what? Let me just give you a little spoiler alert. They're keeping interest rates low. That's right. Should it surprise anybody? Obviously not. I'm going to give you a lot of detail today. We're going to look at some charts and articles that will give you the download on what's happening right now. This is the most jam-packed and informative channel you're going to find out there because you're going to get the condensed information. No ranting, no opinions. Let's get into it right away. U.S. Treasury and the IRS have sent out $242 billion in stimulus checks so far. That's more than half of the $410 billion approved, now distributed. So these people are getting their checks. As I said, for these certain individuals, they are using this for emergencies. They are paying what they need to, and that's a good thing for them. You look at the other group of people who are getting it but technically don't need it. So many cases we had seen previously where people were taking the amount of money, the exact amount, and putting it directly into their Robinhood account and then buying shares with it immediately. To me, that's a bailout of these companies. Not necessarily a bailout that they were failing, but it's just pumping more money in. Taxpayer dollars going in to boost up the stock market. If that's not crazy, I don't know what is. I mean, you're looking at this where we are at the absolute top, the highest it can get, okay? And it's going even higher. And how is it getting there? From quantitative easing, from extremely low interest rates, and taxpayer dollars. Everybody should be upset when you see this kind of indiscriminate spending. But no, this is how they react every single time, all right? They want to be so good and the saviors, and we're going to help you out. But you look at the bill, as you can see here, $410 billion. It's approved to give to the individuals. How much of this money, if we were to really look at it very clearly, how much of that 410 is going to people who actually need it? Probably a lot less than that, okay? But they used the simple metrics. Actually, they have a breakdown if you're interested down below this in the article. But then you realize the bill's $1.9 trillion. What about all the rest of that money? Now, I want to make it very clear. If you're getting the paycheck and you're doing something smart with it, obviously this is something that's beneficial to you. But I'm just saying the way that they set this all up, it's coming from you, the taxpayer. People should be asking questions. Where is the money going? I just covered that maybe in the previous video or the one before that. I think it's important, and that's why I get into it. On another note, we're looking at the Federal Reserve. The Federal Reserve had their newest FOMC meeting. Again, they didn't increase interest rates, and in fact mentioned 2023 rates would stay low all the way through 2021, 2022, 2023. You're going to see rates at 0% according to the Federal Reserve. Now, this is foolish. We have no idea what's going to happen in the next day, never mind all the way through 2023. The reason that they do this is because they are acknowledging to the markets themselves, to the players, the big players, not the retail trader who is completely insignificant. You are seeing this right now being put out there using what they call as part of their tool set. It's forward guidance. Forward guidance essentially is them saying things that move the markets. And in this case here, we're going to keep 0% interest rates. That means risk is on. And how did the market react? Take a guess. A lot of businesses are going to benefit from the stimulus check, at least in the short term. Starbucks expected to get a jolt from stimulus checks and restaurant reopenings because people, they're going to be able to go out, have a little bit of fun. If the restaurants are open, if the Starbucks is open, they don't have to just take out. They can actually sit down there and work on their manuscript and all this funny stuff. But you can see that there will be more spending because, hey, the government just gave you a free check. Now I can buy a $7 latte. Since the last Fed meeting, you could see right here, January 27th, let's check out the performance of gold. And you will see that it has definitely not done as well as the stock market, that's for sure. Minus 6% in this case. And why? This is very, it's such a conundrum for many people. They ask, how can this be happening? If the Federal Reserve is printing all this money, why haven't we seen that boost in gold? And this, to me, right now, this is my opinion right here, I know I don't generally do that, but I want to make it clear. I know many people ask me this, so I want to note this. Gold performs very well when all else fails. That's the key. Right now, everybody's thinking that the financial system is sound. When they lose faith, everything flips on its head. And actually, temporarily, you could have gold drop as well with everything, with stocks and everything starts to come down. However, if we saw during the last recession what happened, that gold becomes that safe haven. But at this point here, there's not enough fear to actually generate an increase there. And you got to remember these prices, this is paper gold. Paper gold, not real physical metals that are in regularly short supply. And the same applies to silver as well. As a result of all this stimulus, as a result of everything that we have seen coming from governments and the central banks, of course, the stock markets in general have performed very well. This happens to be the Dow Jones, but you can see it all over the place. Ever since March, when they said, hey, we're going to destroy the dollar if it's required, the markets have moved up. And nothing has really derailed that. You had seen during the early part here, we were seeing mostly the tech stocks that were just taken off like crazy, like a rocket ship. And then as we moved more into the following months towards, let's say, the fourth quarter, it really started to broaden up. And that's a healthier market. There's no doubt about it. But we have to understand what's behind it. And it is very clear to me that the quantitative easing and the stimulus measures have been the two main factors. The actual economy is not doing well. You're seeing some signs like when we talk about the airlines and so on, but I mean, you just look at it overall, and I'm not sure how certain industries are going to survive. This right here is the most important point I wanted to make in the video. I wanted to read this to you and show you this chart, Treasury Cash. The mechanics of the injection are simple. The US Treasury issued too much, quote, too much bonds at the peak of the crisis last year, which the Federal Reserve bought up via extreme amounts of quantitative easing. This extra cash was then placed on deposit at the Fed by the US Treasury, ring-fenced from the financial system and the economy. It is now being deployed into the market via the mailing out of paychecks as well as other components of the stimulus signed into law. So this right here is something that I have brought to you more recently, telling you that the Treasury cash would start to fall down, and we'll see where it ends up. Will it go down to where it was prior to March, or is it going to be depleted entirely? Who really knows? But we'll see. Definitely the expectation was that this would be $1 trillion of stimulus essentially. We'll note that as time goes on. Some of it will be spent, some of it will be used to buy equities and others kept in cash. But from a financial markets perspective, what is important to highlight is that this is a near literal helicopter drop of dollars worth about $1 trillion. This is big news. This is the helicopter drop that we don't need to be necessarily guessing if it's coming. It's on its way. I wanted to show you this right here. I found this chart interesting, and I think it is worth mentioning. And this comes from John Williams' Shadow Stats. Really quickly, financial versus the trade-weighted dollar indices. And there's a difference here. You look at it, 1985 up until the present, and there's more of a disparity today than ever before. The SGS Financial Weighted Dollar Index reflects a composite value of the foreign exchange weighted US dollar, weighted by the proportionate trading volume of the USD versus the 6 highest volume currencies. The FRB trade weighted dollar is the major currency index published by the Fed, with the USD weighted by respective merchandise trade volume against the same currencies. Okay, a little bit of jargon there, but I just wanted to note the fact that you could see is a big difference. In fact, you are noting the FRB trade weighted dollar is coming in at, hard to see on here, looks like about, let's say, 62. You see the SGS financial weighted dollar at about 55. So there is a big difference. But the reason I'm mentioning this is that when we talk about the dollar, we are measuring it against other currencies. And to me, that's not really a good sign. Now, it does affect you if you're importing, if you're exporting. It does affect you as the consumer in some ways. But for you, if you're working in a place and earn the currency of that country, so you're in the US and you're earning US dollar and you're buying things necessarily, around in your local environment, it has less of an impact to you as to what's happening with the dollar index. But understand that when you look at it more specifically and realize that your dollars are being devalued against real goods, that's when you've got an issue. I went on too long. I know I'm going on too long. There's so much in here, and I've got this I wanted to talk about. There just isn't enough time. We're talking about interest rates and where real investment advice believes that there are some danger levels. For example, if the 10-year rate increases to 1.75% by April, the proxy interest expense will exceed all peak levels since 1990. But they've got to pump it into the money and so on. We don't know what's going to happen, but these are things that I think people should be aware of. 200 years of interest rates in the US. Check out where this has been. 1980, obviously it's an anomaly, and you look at where it went. However, this decline has been unlike anything else we have seen before. We are watching it go down to rock bottom on every single level. Now, more recently, on the longer end, we're noticing that there had been a rise. We don't know what's going to happen exactly, but the expectation is higher levels of inflation, and that will have to be met with higher levels of interest. 10-year yields and the secular GDP growth. If you want to mirror these two and see the comparison, I thought that this was very telling. You could see how this has basically been moving downwards in general over this period. And how is this really the case when we're being told that, if we decrease interest rates, we're going to get better performance? I think it's pretty telling when you look at it and you're, not really trying to get something out of it. You're just taking the information in what you have right here. Same situation, debt, interest rates, and the financial crisis. This is a problem that they will absolutely refuse to acknowledge. Mortgage refinance demand tanks 39% as rates continue to climb. I've been watching this very closely, and you can see right now the rates, they've been going up, and that actually pressures people to get in. So you would think that it's necessarily something as it goes down further, people are pressured, but actually when it starts to come up a bit, that's when people start saying, I think the bottom is in. Now it's time to lock in. So maybe we're already past that point here, but clearly the mortgage refinance demand has slowed. Now the people getting their mortgages, if they're looking at this in a long-term view, it's 3.28%, 3.26%. And, by the time you're watching this video, probably somewhere around that range anyway. But this will be something that we have to watch, and it relates very closely, of course, to what we are seeing with all of these homes and the prices going absolutely astronomical, not just in the United States, of course, but all over the place. Big news right now, Amazon unseats Walmart to become the #1 apparel retailer in the US. I was surprised by this. I know that they do sell a lot online. I know that they are, of course, massive, but when you're seeing Walmart getting surpassed, that to me is big news. Big news. If you're not aware of what Amazon is capable of doing now, basically you are able to purchase from Amazon from their own brand, and you can take whatever, you order 5 things, it arrives, you are taking out 2 things. Oh, you know what? I didn't like that, or this size didn't fit me. You put it back in the box, postage already paid, you send it back. No other company can compete with that level of service. And this is what's happening. You might argue that, they're doing this and willing to lose money and so on. I'm just showing you the trends, and clearly all of these big companies, massive billion-dollar companies, are very worried right now. That is, of course, bullish for Amazon, but they've got to watch out because big giants do fall hard. And we have Jeff Bezos specifically saying Amazon will go bankrupt one day. I don't think that time is anytime soon, but it doesn't mean that they can't make mistakes. So they've got to be careful as to what they do, but still innovate so that it can push the stock higher. I will do an entire video about this, but this is so important. A new law would force employees to contribute to their 401ks. That is more theft. They take it out through the taxation. Now they're going to force people to contribute to their 401ks. We'll see what happens. Wells Fargo CEO is bullish on the US economy in the second half of the year. This is the sentiment of the financial sector. But hey, the stimulus checks are coming through. It's going to be bullish for the markets, at least in the short term. So is he wrong? Well, we'll see. That's all for this video. If you found that informative, hit that thumbs up button. When you do, you are supporting me. I want to thank you for that. Just click that button on your screen. Thank you. If you want to learn about e-commerce, the Amazon, GPS.com. Do you want to understand the financial system? You want to top to bottom, or maybe you got a friend or family member that needs a little bit of waking up? These 2 books are the ones you've got to check out. Link in description. Have you seen this video yet? If not, you have to check it out. A lot of detail. There's so much for you to see right here. Click it and I'll see you there.